Hello and welcome to the March 2016 Downtown Pittsburgh IBD Meetup presentation. My name is Eric Rossi. I'm a co-organizer for this meetup group. And if you're not familiar with the meetup page, there's a link here. You can go find the group's homepage. Introduction. So the group's mission statement is to educate individual investors about the CAN-SLIM investing strategy. And this means identifying the best educational material from sources such as books and articles, webinars, videos, etc. And a disclaimer, this presentation is educational in nature. This should not be construed as recommendations to buy or sell securities. Investing in stocks does carry risk and can result in loss of your capital. I'm a non-professional volunteer investor, and Investors Business Daily, IBD, and CAN-SLIM are registered trademarks of Investors Business Daily Inc., and Meetup is a registered trademark of Meetup Inc. Here's the topics for this month. First, we're going to go over the market dashboard, as usual. Then we're going to talk about the best performing stocks of 2015. Then I'm going to do an investing book review, Nicholas Darvis' book, How I Made $2 Million in the Stock Market. Then we'll do a market analysis and recent stocks, and then we'll conclude. All right, here's the market dashboard. Same thing we did last month, just updating the indicators here. So as of the time I did this presentation, the market was in a confirmed uptrend, so we get a green for that one. The uptrend is almost 7 weeks old now, or 6 weeks old. So typically, stocks will break out in the first 4 weeks of a new uptrend. So I'm giving that one a yellow because we are still in an uptrend, but it is kind of an old uptrend. Distribution days, right now we've got 2 on the S&P 500 and 4 on the NASDAQ. It was recently 5, but either way this gets a yellow. The Fed activity, so the Fed raised interest rates in December, and they are holding off so far for additional rate increases for this year, but they are still forecasting 2 interest rate increases this year. So I'm giving this one a red. Okay, the S&P 500 right now has a B- accumulation distribution rating. It just turned to being slightly up for the year. It was down for most of the year up until now. So the B- rating gets a green. The NASDAQ is at a C accumulation distribution rating, and it's still slightly down for the year. So the C rating gives that a yellow. And the IBD 50, I've had this at red for most of the year, but I just changed this to yellow because it is trading above the 10-week moving average. It's been doing that for some time now. It is still below the 40-week, and it is down for the year, and it is underperforming the NASDAQ and the S&P 500. So I gave that a yellow because it's not seeing a lot of distribution, but it's kind of going up in lower volume. So I felt like a yellow was good there. That one's a little subjective because IBD doesn't provide the accumulation distribution rating for the IBD 50. All right, last part for the market dashboard. These values are the same as they were last month. Our last bull market, we're currently still arguably in a bull market, and it is more than 3 years old. So this gets a yellow. Although I made a note here that we could be transitioning to a bear market. Still unclear about that. And we'll look at that when we look at the monthly chart on the NASDAQ during the market analysis. The last bear market ended more than 5 years ago, so this one gets a red. And we've had 9 intermediate corrections since this new bull market started, so this definitely gets a red. So you can see overall we've got a couple greens, we've got a few yellows, and we've got some reds. So still, it's okay to be in stocks right now, but it's a good time to be cautious. I'd like to see a lot more greens here. And that would really happen if we went into a bear market and then started to see some strength coming out of that bear market. We would start seeing a lot of greens here, and that would really mean it's go time to start investing heavily. So it's okay to buy stocks right now. I'm keeping tighter stops, and I'm going for smaller profits right now, which I'll talk about. And I think it's good not to be heavily vested. So a lot of my portfolio is still in cash personally. Okay, I had a question a couple months ago from one of the members about how to find the big winning stocks before they go on to make their moves. And so I thought I would do a little segment here about the best performers from 2015. And IBD provided a list of the top performing stocks of 2015. And I just posted that PDF file on the Meetup page under the More section and then Files. So I did a little bit of analysis on this list, and I don't have time to share all the results here, but I spent maybe about 5 hours looking at this thing throughout the month. And what I did was I went back and I looked at what were the IBD ratings for these stocks at the beginning of 2015. And then I looked for about the top 10 stocks. I looked at how did their IBD ratings change throughout the year. And like I said, I didn't have time to put all the data together here to present it. So these are really just the summary points here. But what I found, some observations, is that actually many of these stocks did not have great IBD ratings at the beginning of the calendar year. So you would think the best performing stocks, they probably would have had pretty good ratings or great ratings at the beginning of the year if they ended up being the best performers. But that wasn't the case. A lot of them had low ratings in terms of earnings per share, EPS. Some of them had low composite ratings. The SMR ratings for some of them were pretty low. And some of these stocks had poor IBD ratings, especially I noted EPS, even while they were making their big moves, and even after they made their big moves. So some of these stocks performed really well throughout the year, but their IBD ratings weren't very good. So I thought that was an interesting point, and I think the takeaway here is that you don't just have to look at stocks that have a 90, 95 plus composite rating, EPS rating, etc. It's okay to look at other stocks and look, and maybe you want to look at composite ratings 80 and above, let's say, or 85 and up. Now that's going to make your search, you're going to have to look through a lot more stocks doing that. But just because a stock doesn't have stellar IBD ratings right now, it doesn't mean it's not going to be a good performer for the year. So the one thing that stood out in this evaluation I did is that the RS rating appears to be the most salient of all the ratings. So even if a stock had below average, or let's say it didn't have great EPS rating, SMR, accumulation distribution, or composite ratings, all of these stocks had good RS ratings. If they didn't have it at the beginning of the year, they definitely had it while they were making their big moves. And when I say a good RS rating, I'm talking like 95 and above. Many of them had 99, especially when they were peaking later in the year. And this is probably, I think, the most important takeaway that I got out of this is that accelerating RS rating seems especially important. So some of these stocks did start the year with lower RS ratings because they weren't performing that well at the beginning of the year. But as they went on through the year, the RS rating would start jumping up. So let's say it started at 32, would jump up to 50, 75, eventually end up at 98, let's say. So there's no screen right now in IBD that I'm aware of to look for accelerating RS rating. But if you are a MarketSmith subscriber, you can set up a screen to do this. And I'm going to do this actually. I'm going to set up a screen like this in April and start looking at this to study this for the rest of the year to see how this really works out. So I'm just going to take a snapshot of RS rating for maybe all the stocks in MarketSmith, or maybe everything with a certain RS, with a certain composite rating and up. And I'm going to have Excel do a comparison each month. And then you could look for the stocks that have the largest change in RS rating. So, like I said, IBD doesn't have a screen for this right now, but I think the biggest takeaway from here was that the RS rating seems to be the most important, and if a stock ends up being a big performer for the year, you can guarantee the RS rating is going to be big at some time, although the other ratings may not be. Accumulation distribution will tend to follow RS. So if the stock's under a lot of accumulation and it's performing its percent change for the year is a lot, you're going to tend to see accumulation distribution be an A or B as well. But EPS, SMR, and composite, while many of the stocks did have good ratings there, a lot of, there were quite a few that actually didn't. Now, another thing I noticed here that I didn't note in the slide is that some of these stocks had a random news event, such as maybe a merger talk, or they issued some new product that got some certification. Some of these stocks on the list I saw, they really didn't have a steady increase throughout the year. They had like a week they were up 70% or 50%. So those stocks I ignored because those are kind of fluke events that you can't really predict. So I tried to stick with the ones that showed steady upward movement throughout the year. And the moves they still tend to be biased around earnings time. Most of the stocks move is around earnings time, but it wasn't extreme. I stuck with like a 30% threshold. So if a stock was moving up, let's say 30% or less on an earnings report, I kept it on the list here. But if a stock was up a week 50% or 70% and that accounted for most of its move for the year, I kind of ignored those stocks. So again, if you want to see the list that IBD posted, go to the file section on our Meetup Groups page. Okay, next topic is an investing book review. So this is a classic investing book. Nicholas Darvis wrote this book, How I Made $2 Million in the Stock Market. And I just read this, and when I read books, especially nonfiction, I take notes as I go through them. So I'm going to share my notes here. At least I thought the most important points that I took away from this book. So just a little background, Nicholas Darvis was actually a professional dancer, and he turned eventually into a professional trader. So this book describes his journey from starting as an amateur investor to becoming a professional trader. And many of his conclusions are parallel Bill O'Neill's advice. And actually, Bill O'Neill likely used Nicholas Darvis. I know Bill O'Neill had some folks that he liked, such as Gerald Loeb and Jesse Livermore. And Darvis was potentially another influence on Bill O'Neill. I'm not 100% certain about that. But it certainly seems that his advice is similar to Bill O'Neill's advice. And Darvis's profits totaled about $2 million, and that would be nearly $16 million in today's money. Okay, so Darvis, he had tried both a purely fundamental approach and then he tried purely a technical approach, but he found that neither of them worked consistently on their own. And this led him to create a hybrid approach that he called his techno-fundamentalist approach. And this was really centered around selecting stocks that have strong earnings and sales growth, and then waiting for the stocks to make a big move in heavy volume. So this is pretty similar to what IBD and Bill O'Neill teach, right? We look at fundamentals, and then we look at the technicals by reading the charts. And then when stocks break out of some kind of consolidation, like a base, it's good to buy them. I'll talk about how he actually didn't use charts, which is a pretty interesting point. I'll get to that one later. But he looked for stocks with strong fundamentals, and then he waited for them to start showing signs of high volume accumulation. So he really looked for unusually high volume in stocks. He has a theory in his book called the box theory, where he talks about stocks that are moving up, they form boxes as they move up, one box stacked on top of the other. And this theory is similar to the theory of a flat base, or let's say a square box base, and it utilizes the concept of support and resistance because he talks about when a stock breaks out of one box, it should start to find support at the top of that box. And when a stock starts hitting resistance at the top of a box, he would get cautious and consider being ready to start to sell that stock if it dropped in price. He also said you're bound to be wrong about half the time in the market. And this is pretty consistent with, I believe Jesse Livermore said that if a speculator is right half the time, then he's doing well. And even if you're right 3 times out of 10, you should be able to be profitable overall if you cut your losses quickly. So this seems to be a theme that a lot of successful investors, successful traders find, is that even with evaluating the fundamentals and even with looking at the charts and even with buying it at exactly the right time, you're still bound to have a loss half the time. So this is why it's so important to cut losses quickly and let your profits run. And then to avoid selling a rising stock too soon, Darvis would raise his stop order as the stock rose. So as the stock rose higher, he would also raise his stop order. Now, he didn't put it too tight with stock because he didn't want to get stopped out too quickly. But the point here is that if a stock's up 10%, let's say, there's no reason to let it go back to a loss. And if a stock's up 20%, there's no reason to let it go back down to let's say, even. And if a stock's up 100%, why let it go down to 50%? So, you have to decide for your investing strategy what's your sell rules, especially as stocks, if you have a stock that keeps going up in price. Okay, Darvis, when his trading started to improve dramatically, he would write down why he bought or sold a particular stock. And he did that so he had it for future reference. Because when you look back 6 months later or a year later, sometimes it's hard to tell, why did I buy this stock and then why did I sell it where I sold it? So for post-analysis, it's good to, you could keep a journal or you could print out the charts and mark them up. But this seems to be another trait of successful traders. And if Darvis took a loss on a stock, then he wrote down the reason that he thought caused it. And I like this. This is something I'm going to incorporate in my post-analysis from now on. Because I think it's good to understand, well, okay, if I did take a loss, why? Why did that happen? And if he took a loss on a stock and he still, he had already looked at the fundamentals and clearly the stock had some good technical action. But sometimes even looking at even a stock with great fundamentals and then buying it when the technical signs are good, you may still take a loss, as I talked about in the last slide. So if he took a loss on a stock once, he would give it another shot. If it moved up again in a heavy volume, he would give it another shot. But if he took a loss 2 times, then he would move on to other stocks. I actually think 3 times is a better rule here, and that's my rule. But again, you can decide for yourself. If you take your losses smaller, if you cut your losses instead of 7-8%, if you cut your losses at say 2 or 3%, I think you can afford to try the stock a few times before moving on. One point Darvis made, which I liked, said that bear markets are always followed by bull markets. Something good to keep in mind if we go into a bear market, because I used to think, oh, the market's crap, I'm just going to ignore it. I'll come back when it's good. And now I know that that's a bad strategy. When the market's at its worst and people are very pessimistic and all the Wall Street analysts are saying that the market's terrible and the outlook's terrible, that's often when things will turn around. And I know now that bull markets have their biggest returns early in the bull market, which happens right after the bear market ends. So this is a good point. And then this was really interesting. Darvis actually never looked at charts. He only looked at prices in the newspaper, or when he was traveling as a dancer, he would actually get telegrams every day. And he had a system, he had like a code system set up with his broker so that he wouldn't have to send these really long telegrams because they were expensive. And so they had a code set up where they would send the ticker, and his broker would send him a ticker with some prices and maybe a letter to indicate what each price was, whether it was the price at which he bought or sold or the closing price. But I thought this was interesting that he was so successful and is still regarded as one of the more successful traders of our day, and yet he was a mental chartist. He never actually looked at charts of any of his stocks. So with all of our tools today, like MarketSmith and Leaderboard and all the charting services that are available for free, we should definitely be able to equal what he did, if not do better. Because in my opinion, not having the chart was a disadvantage for him. And I mentioned while traveling abroad, he would receive telegrams each day with updates on his stock. So he actually didn't even know necessarily during the day if a stock was being bought, sold, or held. He had no idea what was going on until the end of the day. So he would put in orders with his broker and say, put in a stop order to buy this stock at this price, or put in a stop order to sell this stock at this price. And he didn't know what was going to happen until the end of the day. So he wasn't influenced by intraday swings or anything like that. And one point in his investing career, he moved to New York, and he actually started. He was in a broker's office, and he said he started obsessing too much over intraday swings, and he started kind of breaking a lot of his rules that he had developed early on, such as don't take advice from other people and don't make decisions based on rumors. He started doing a lot of that stuff when he was in New York, and his results started to erode. So he actually moved back to Paris, and he wanted to be far away from Wall Street and far away from a broker office. So he went back where he was, he was kind of in isolation to some extent. He was in a different country, and he said he went back to his broker and he said, I want my telegrams I want my daily telegram, and we'll do it just the way we did it before. And once he did that, his results started improving again. So I think the takeaway here is don't be too much influenced by intraday price action. Have your sell rules, and they should be based more on a longer term approach than intraday, unless you're doing day trading, of course. So that's a different story. We're not talking about day trading or swing trading here. We're talking about growth stock investing. So I mentioned he would to make a trade, he would place an order with his broker, and then as soon as his buy order got filled, he instructed his broker to immediately place a stop order at whatever he decided, wherever he decided he was going to cut his losses. So immediately when the stock was bought, an order went in to sell it if it dropped below his stop loss. So he never took any big losses with this approach. And I mentioned he didn't know if his stocks were bought or sold until the end of the day when he received his telegram. And Darvis did use add-on buys for stocks that continued to advance. So overall, definitely a good book. It wasn't a long book. You could read this in a couple days if you really wanted to. And it was definitely shorter than How to Make Money in Stocks by Bill O'Neill. But it definitely had some good beliefs to reinforce, and then I got some good tips about post analysis in there, and not obsessing over intraday price action. That's a good reminder. And I thought it was a good point that he would raise his stop loss amount as the stock rises. So I think those were all good takeaways from this. Okay, next we're going to do the market analysis. So the market's been in a confirmed uptrend for about 6 weeks now, and the NASDAQ has 6 of 8 weeks that were up, and the S&P has 6 of 7 weeks that were up. So a pullback right now would really not be a surprise with that much. When when the indices show that many up weeks in a row, usually it means it's time for a down week to come. So we just need to be ready for that. The NASDAQ did recently breach the 200-day moving average. So that's a good thing. It's now residing above both the 50-day and the 200-day. And the S&P 500 is doing the same thing. The S&P 500 it broke through its 200-day moving average before the NASDAQ. However, the upside volume is declining, and we'll look at this in a second on the chart. And upside volume is generally low. So we'd like to see volume increasing as these indices move up. And a lot of growth stocks, and we'll look at the IBD 50 index, which is showing the same thing, but a lot of growth stocks are doing the same thing. I was just looking at Facebook yesterday, and yeah, it's moving up. It's been moving up for a few weeks, but the volume's just not there. And I'm seeing that a lot right now. So one thing to watch for is for the NASDAQ I'm referring to here, but I think this applies to the S&P as well. Watch for the 50-day moving average to work its way above the 200-day. That'll be a good sign if that happens for if we're looking for the market to go higher. And there are still not many stocks breaking out of sound bases and making significant gains. What I've been seeing at least is stocks that break out of a base and heavy volume and they immediately reverse the next day, and then they revert, and then they're down the next day after that, and you have to sell it to cut your losses, and then the next day it's up, and then it tries to break out again, and it just seems like these things are going, they just can't decide which way they want to go. So it's hard to make a lot of progress in this market right now. And leadership is still from defensive sectors, especially utilities have been on the new highs list lately. And utilities tend to they tend to be more affected by interest rates too. So there might be the utilities might be leading right now because of what's going on with interest rates. I don't know for sure, but anyways, utilities are not a high growth sector like technology or cybersecurity or biotech or something like that. So, those are the types of sectors we want to see leading. So overall, it's okay to own stocks right now, but it's probably not a good idea to be too heavily vested. Most of my portfolio is in cash, but I'm still doing some trading just for practice more than anything. And it's a good idea to keep tighter stops than normal right now because the market is still kind of choppy and volatile. And it's a good idea to take your profits sooner than normal. So I'm using right now like 2 to 3% stops and shooting for a 10% profit goal. Now I can tell you a lot more stocks can be hitting a 2 or 3% stop than the number of stocks that are hitting the profit goal. So again, it's a frustrating time. It's hard to make a lot of. I don't really know anybody making a lot of progress right now, except people. The only people I hear that seem to be doing pretty well right now are day trading or swing trading. But if you work for a living like I do, it's hard to sit there and watch a chart intraday and day trade when you got meetings and stuff. So I don't day trade. But if I was a full-time trader, I would be day trading right now. Okay, I'm happy to report I am a proud new MarketSmith subscriber. And I've been thinking about this for about a year, and I finally took the plunge. And I gotta tell you, I absolutely love MarketSmith. And you might look at the price and say, well, geez, this is way too expensive. But my thought is, I didn't think about what it costs, but more what it could be worth. Because a MarketSmith subscription, if it helps me get better returns and it helps me take my losses quicker, and if it gains me better returns on my stocks overall, then I think it's going to be well worth it and going to pay itself off. Maybe not this year, but particularly in a good year. And it's a huge time saver too. Especially if you work for a living, and I work for a living, have a baby at home, so it's time's really precious right now, and I find MarketSmith does save me a lot of time. So for me, it's really worth it. So anyways, we'll go into market analysis, and then we'll look at some recent stocks, and then we'll conclude. So I'm going to switch over to MarketSmith. Okay. So first, we're going to take a look at the market. So this is just one example here in MarketSmith. You can look at, I could bring up a chart of any of the 197 industry groups and see how that group overall is performing on the chart. I'm not aware of any way to do that except in MarketSmith. I don't think you can do it on investors.com. And then they have all the market indices listed here, and you can see all these market indices. I mean, they just have a ton. So all I did was flag the ones that I want to follow, and boom, they come right up here. So let's look at the NASDAQ. I'm going to start with a monthly chart. This is another thing I love about MarketSmith is I can put my own annotations and trend lines on the chart, and they just show up, and they show up on my phone. So right now this was the financial crisis right here, 2007 to 2009, and ever since then, since early 2009, when this bottomed out. So this was March 2009 when this market bottomed out. We've been running a long time here, and we've been running without a significant correction. So I drew this line connecting these a few points here. We got like 3 points, almost a fourth point here. So I thought this was a good representative line. Now you can see that this line was broken in last August. So another thing to look at here is that from March, this was March 2000 when the technology boom was going on. And this was the ultimate peak here. And this is another thing I love about MarketSmith is it tells me these key price levels. But you can see 51.32, and then we poked above that a little bit here by about 100 points. But you can see overall we didn't move decisively above this. I mean, a good sign would be the market moving above this prior resistance point and then starting to find support there and moving higher. And that's not what happened. It bumped its head up against this and just didn't make a lot of progress above that. Another thing to look at here is see how relatively tight all these weeks are. Okay, there's a lot of tightness here. Now, look how wide this week is. And this is the week when the trend line was broken as well. And then look how wide this week was here. So it looks like we had some pretty tight action here for a long time up until August, and there's been some tighter weeks here. But it looks like the weekly spans since August have been on a monthly chart are more wide. They're a larger span than they have been in the past. So it looks like there's kind of a change of character going on here. And the fact that we've been running for so long, we've been running for 7 years now, we're definitely long overdue for a bear market. And I'm ready personally. I want to see something like this happen here because I know that when this happens and we start turning around here, that's when the big gains are made. Okay, so here's a weekly chart, and you can see for the past month we've had some up. I mentioned earlier we've had a number of up weeks here in a row on the NASDAQ, and we had this 40 about the 4,300 level became that was kind of a support level here. You can see we closed above it here, although it dipped below it here. So this would be, I would say, the next big support level to look for. You might also say right here, the low here around 4,500 is another support level. But you can see that we're above the 10-week, we're above the 40-week now. If the market's going to go decisively higher, I'd like to see the 10-week come above the 40-week and stay above it. you can see that after it crossed below here, this is called a black cross, the 10-week crossing below the 40-week, it then moved up just barely above the 40-week, and then it came back down. So the other thing to look at here is the volume. You can see the volume here has been light in the past month, and it's trending downward as the market moves up. So that's wedging action, which is not really what we want to see. Okay, and we just moved above the 200-day moving average here. So we'll see what happens. Next week will be interesting to see if we hold the 200-day or if it closes, if it drops back below it. But again, we've had a lot of, the market's been, it was 4,200 here. Now we're at 4,900. So Nasdaq's up 700 points, maybe 15% or so in this time frame. So that's a pretty big move in 5 or 6 weeks for these indices. So again, if next week was down, would not be totally unexpected given the fact we really haven't had we've had like one down week in here. Another thing I point out here is you can see how the market kind of formed these two double bottoms. And the reason I formed the bottom here is based on the closing on this day. This was August 24th when they had the flash crash, which they said was mostly caused by computer trading and algorithms. So if you look, this low actually did undercut the low here, and it undercut the close on this day. Because if you look, this action here, this was gone by 10 a.m. that trading day. It might have even been gone by 9:45. So I'm kind of ignoring that. And I said, well, we kind of formed a double bottom here, and then we just formed another one. So one thing I am looking for is if there's another sharp sell-off like this, you can see how sharply this sold off. Same here. I'm going to actually be looking to maybe buy a Nasdaq ETF and go long just for a couple weeks. That's an aggressive play. It's a speculative play, but you can see that we had this ended up being somewhat of a support day here. It closed at 60% of the closing range. Or you maybe could have seen some changing character right here as we had 2 up days, and then we had a third up day where it jumped above the 10-day. Here, this low you can actually, I mean, after the fact, I guess it's easy to say this, but you can see that we had definitely a support day here as we closed at 80% of the range. Then this day closed at 43% range. Then this day closed at 68% range. So you can see that the market, it was putting in a bottom here around 4,200. So if we see this type of action again, especially if it gives us a double bottom type structure like this, we've had 2 of these recently. So if there's another one and I start seeing some support days like this, I'm actually going to consider buying some stuff just for a short-term gain, more like a swing trade. So let's look at the Nasdaq. Next, I'm going to look at the IBD 50. And again, you see a similar thing. This doesn't go back to 2009, but we've been run quite a bit here. And you can see that I could actually draw a trend line here. And you can see if you kind of draw this trend line, this would almost connect down here as well. But even if I drew one right here, either way we've broken both of those trend lines. And and you can see that I'd say the same thing here, the weekly span or the monthly spans here. This was a wide month, this was a wide month, this was a wide month. So it kind of shows that a similar changing character as to what I showed in the Nasdaq earlier. Okay, and right now the IBD 50, we're trading above the 10 week, which we've been doing that for about a month now. Still need to still see if it's going to test the 40 week, longer term 40 week average. And you can see similar action here as this thing's going up. Volume just hasn't been there. Volume's just been light, that's after we had a heavy volume sell off here. We had a good week there. We had a heavy volume sell off here, and then the heaviest volume week turned out to be a support week, closed in 80% of the range. But ever since then, just the volume hasn't been there. Past month has been pretty uneventful. And the 85.85, which is also what's included in the Your Weekly review, you can see something similar. This is closer. This is about touching the. This is only 0.5% away from the 40 week. So that's the market analysis. Oh, let's look at the Russell 2000. So the Russell 2000 has had a larger correction than the Nasdaq or the S&P, and it's down. If you look, it was down. I made a note here, 27% from this June peak, which is up here, to this point here in February. So this was in bear market territory, and we had two legs down here. We had one leg down shown here, then we moved up a little bit. We had another leg down here. These two legs were pretty symmetric. So coming up here and testing now, you can see this is testing the 40 week. If we had another leg down that undercut this one, that'd be three legs down, which often can be a turning point, at least for a short-term low. So this one you can see the volume's been a little better on this index. We've had a lot of these weeks are closing at the top of the range, and volume's been closer to average or above average. So this index is looking like it's recovering a little bit better than some of the others. All right, let's look at some stocks. So I'll share two positions I own right now. PayPal is one of them, and I bought this because I've been looking at new issues lately, and this one just happened to break above the price that I was looking at. So if you look on the weekly, this is still forming its first base, and they're calling it a consolidation because there was really no uptrend here. But you can see that it's relatively close to a breakout into an all-time high here. It's trading at 39 right now, and the all-time high is 42. So since it's been moving up here, it's found support. It's been finding support at the 10 week, so that's good. Volume has been similar with the rest of the market, a little lackluster, but the relative strength line's pretty good. It's near a new high. So let's take a look at the daily chart. So I first bought the stock when it broke above this point right here, 37.77. I viewed this as kind of a flat. This was kind of they call it a consolidation. I get it's too deep to be a flat base, but it's basically like a flat base. And so I saw we had 37.68, 37.77. So this is I thought this was a good point of an early entry. And then you could use 38.50 as another one. You could use $40, which I made an add-on buy when it broke above $40. And I'll make one more if it breaks above 42.55. This day was a little bit scary right here. Luckily, it recovered later in the day, and I don't sell my stocks early before 1 o'clock in the afternoon typically, because this type of stuff happens quite a bit. So you can see in MarketSmith, I have all these alerts set at different price targets. So you can set an alert at your profit goal. You can set an alert where you want to make an add-on buy. You can set your alerts where you want to cut losses. So It really is it's a huge time saver. It'll also give you the IPO price, which for a new issue is important. Although I don't actually I'm not sure why it's not showing up here. Usually it'll show you the IPO price. All right, anyways. And then the other position I have right now is Nvidia. So this formed a second stage cup with handle. It kind of looks like a double bottom actually. You could have made an early buy right here. I didn't have it on my watch list at this point, but you could have made an early buy when it broke above this 29.45 point. I bought the stock when I used a sloping trend line on the handle, so I did something like this, and when it broke that, I made my first buy, and then it had a breakout. Market Smith will tell you right here. It shows you the breakout day, which is right here. So it had a breakout. Volume wasn't great on the breakout, although it kicked in a couple days later. And it's ever since then it's going well. It's making new highs and it's holding the 10-day moving average. So this is looking like a pretty classic what we want to see. You can see the cup with handle characteristics here. So yeah, we're in new high ground. I love this about MarketSmith too with pattern recognition. It tells me how far it is from the pivot and how long it's been going. So our S line is in new high ground. So this one looks good. All right, so I'll also share some stocks I recently owned. Ollie's Bargain Outlet. This stock, this is looking kind of similar to PayPal. It's a new issue. Here we've got the IPO price of 16. That's what I was talking about before. So I bought this on a sloping trend line here on the handle. When it broke that, I bought. I think I actually bought it right here earlier in the day, and I actually sold it the next day because it failed. It didn't break above the trend line, and then I bought it again, and then it ended up breaking out of this 22.53 buy point. You could have also used this 22.22 as an early entry, but you can see what happened here. I mean, I bought this and it went up a little bit, might have been up like 5%, and then it just came crashing back down. And I tend right now to use the pivot point as my stop loss. So if I bought it and it broke out, I would use 22.53 as my stop loss. So I sold this. I lost money on this trade. And then you can see ever since then it's been going up, but volume has been light. And I'm looking at this. I'm just kind of watching this now. I'm not necessarily going to buy this again because I bought this. I've owned this twice now. But you can see this was at 23.89, so this is forming like a little mini consolidation right here. It actually just broke above it Friday. So you could consider, if you own the stock, you could make an add-on buy here, or you could just give it a shot if you want to own it and you don't own it yet. And then you can see the prior high was 23, so that was another point you could have used as a. You could use this as another place to add to your position. Max Linear, this stock disappointed because this stock has fantastic fundamentals. Look at the earnings growth here. I mean, this is some of the highest earnings growth I've ever seen, and the sales growth too. You know, the IBD ratings are great. Fund ownership is up. It's in a strong group. Semiconductors are strong right now. So this was a third stage cup with handle. You can see the characteristics there, or a cup base rather. And I bought it on the breakout, and you can see it broke out, and then volume was heavy too. And then it pulled back a little bit. And then if you wanted to, you could have used a trend line here to maybe add to your position. Or if you missed the initial breakout, you could have bought it. Right here. Would have been a good point when it broke the trend line because it also closed above the pivot there. So I did buy the stock. I don't remember what day here, but I did buy this, and I ended up selling on this day for a small loss because it closed below the pivot, which is what I used as my stop loss. And it just barely, I mean, it was close. But again, you can see since then it looks similar to Ollie. It's been going up for about a week, but just volume's been just light. So I might consider rebuying this one. It's forming a little mini consolidation right here. So if it breaks through that, I could consider buying this. But this one was disappointing. I thought this was going to be a good one. Square, this is a new IPO, and I'm just looking at new issues this year just because IBD's found that they can tend to have the biggest gains, IPO bases. So I looked at this. I bought this when it broke above this. I looked at this as an early entry point here. So the high point here, if I go to a weekly chart, so the high point here was 1478. So I use this as an early entry point right here. Okay, so that's an early entry point. You could add to your position right here, or you could use this as another early entry. And then the final, the normal buy point would be 1478. Now you can see that it broke out. It broke above this base here, this cup, but it closed this week. It closed at about half the range, and it closed under the buy point. So that's not what you want to see. Volume's been decent though. Volume's been, I mean, you can see volume's going up as this thing's moving up in general. So that's good. But look, I mean, I know I bought the stock on this day, and then look, 2 days later it's down 3%. And then if you bought the stock on the breakout here, boom, there goes. Now 2 days later, it's down 7% in above average volume, and your gain is gone. So it's just really frustrating when this type of stuff happens. And this is why I think it's important to cut losses short right now, like 2 or 3%. And if you buy a stock like this, and you do take like a 2 or 3% loss, like right here, if it goes back above this point, it's okay to buy it again. Because sometimes some of these stocks you have to try several times before they work. One more I'm going to show is Avexis. This is another new issue. And you can see on the weekly, this looks pretty good. This has been moving up quite a bit. RS line is screaming higher. And it's too early for an average volume, but volume's been decreasing as it's going up, which is not great. And then you can see this week closed below at 36% of the range in the heaviest volume. So that's not a good sign. But this one, if you look at this stock, so I was looking at an entry right here, and I bought the stock here, and then it was up 7%, and then look, the next day, down 5%. And then the next day, it's up 6% above the buy point again. And then the next day, it closes just below it. And then it's up 11%, and then it gaps up 6%. And then 2 days later, it's down 11%. So I tried this stock, and it was whipping around a little too much for me, and I don't like these wide swings on a daily. That's too much volatility for me. So I'm not messing with this anymore. I do have an alert here, a trend line alert, just for kicks, but I'm not going to try this again. But this is one you could keep an eye on it. If it hit about $30 a share here, it might form a new little mini consolidation here. But it is up. I mean, you can see from the IPO day, it is up quite a bit. Even from this point where I was bought at $24, it's up $2. So that's maybe 8% or so. Actually, one more I'll show you is Domino's. Domino's Pizza. I bought this stock on this gap up day from the earnings report. I wouldn't normally buy a stock like this because this isn't a high growth name, but these defensive sectors right now, like foods, are leading at the moment. And this stock has a history of gapping up on these earnings reports. You can see some of them here. And I know that this was an earning report. I can actually go to MarketSmith here and it'll tell me that February 25th was the earnings report. So this was the week of February 25th. Another time saver. So I bought this stock on this gap up here, and normally I would probably use the bottom of the gap up day as my stop loss, but in this case that would have been too much. I would have taken too big of a loss if that happened. So as it went up here and it kind of formed a mini correction here, I used the bottom of this day. If it closed below the low on this day, that was my stop loss. And I was going to plan to take a 10% profit on this. And it started to drift down here, and again I had to sell this one for a small loss. And you can see since then, just like the last few we looked at, it is going up, but volume's kind of low. So overall, I mean, you can see I've probably had what, 1 or 2 winners and 3 or 4 losers there. So kind of consistent with what Nicholas Darvis said earlier. Bound to be wrong about half the time. I'm probably wrong more often than that. Okay, so that concludes this month's presentation. So if you found this video on YouTube and you're not a member of the meetup group, then you can follow the below link and join the meetup group. All you need is a free meetup account. And why should you join? Well, there's files like this presentation that are available to members only. And when I post a new presentation like this or a new video, you'll be notified if you're a member of the group. There were no questions from last month from any of the members. So, in conclusion, future topics for next month, I'm gonna keep doing these investing book reviews because I've read last year. I read a handful of investing books, and I'm reading another one right now. So I'll keep doing reviews on those to share what I think are the most salient points, and then we'll look at some more recent stocks. I'm going to do a more detailed analysis in terms of fundamentals and the chart reading next month for a couple stocks that I owned either last year or earlier this year. So if you have any suggestions on future topics, just send those to me through the meetup. There's the messaging through meetup, and just send me a message and I'll include the answer in a future video. And thank you, and we'll see you next month.